Part 1. $1.7 trillion gone in 90 minutes. I want you to sit with that number because it isn't a headline, it's a force. It's more than the annual output of entire countries, erased faster than most people finish breakfast. The mainstream explanation will be simple because simple stories travel faster than true ones. Profit-taking, volatility, overbought. Words that sound like reasons without actually explaining mechanism, but this event had a fingerprint, and if you know where to look, you can see it. A multi-decade technical boundary that silver had not truly defeated, and a mechanical tripwire inside the future system that turns normal selling into a forced liquidation cascade. Those two forces hit at the same time, like a match tossed into a room full of fumes. That is how you get an hour and a half that wipes out paper wealth on a scale that feels impossible, until you understand how modern markets are built. So let's do this the right way, like an investigation, not a reaction. We're going to answer 3 questions that matter more than the price print itself. Why did silver drop so much harder than gold? What specifically caused the acceleration? Why did it get so fast, so suddenly? And most important, was this the end of the bull move, or the kind of violent reset that bull markets use to shake people out right before the next leg higher? To solve that, we start with the simplest truth about charts that almost nobody respects until it hurts them. Markets remember levels, and the longer they remember, the more brutal the reaction when those levels are hit. Here's the mental model that changes everything. Support and resistance aren't mystical lines, they're crowded memories. Support is a price level where buyers historically show up and push back, a floor that catches the fall. Resistance is where sellers historically show up and cap the rise, a ceiling that stops momentum cold. And the most dangerous ceilings are the ones built over decades, because they aren't west held up by one trade. They held up by thousands of decisions made across multiple cycles. When silver surged to that $117 area, it didn't just hit a number. It struck a 30-year boundary that had defined major turning points in this market, and it struck it at speed, with leverage, with emotion, and with the entire world watching. If this breakdown is helping you see the market differently, take a second to like the video and subscribe, because this channel is built for exactly this moment. The stuff the headlines skip the mechanics underneath, the move the hidden economy that decides who keeps their capital and who gets shaken out of it. And now, let's connect the dots the way professionals do it. When traders zoom out on silver, they see long regimes, extended channels where price repeatedly bounces between invisible walls. From the late 1990s into the mid-2010s, silver moved inside a descending structure, and within that structure there was a central line, a defining level that acted like a magnet in moments of crisis. In 2008, silver crashed into that line near $8 and, after the panics, launched into a historic run that carried it toward $45 within a few years. That line acted as a floor. Now fast forward to the recent cycle. Silver has been rising inside a new upward structure, but the key is not the slope of the channel. The key is the meeting point with that same multi-decade line. This time, silver approached it from below, not above. The floor became the ceiling, and when a market hits a ceiling that has 30 years of memory behind it, the rejection is not polite. It doesn't tap and drift lower, it slams. Because everybody who has been waiting for that level to sell, hedge, or reduce risk acts at once, and everybody who is late to the party realizes, at the same time, that the door is smaller than they thought. That is the first driver of the crash, a textbook, multi-decade resistance rejection that was predictable if you zoomed out far enough to see the real battlefield. But technical levels alone don't usually erase double digits in 90 minutes. For that kind of speed, you need a machine, and the machine is leverage. This is where the story turns from chart talk into plumbing. In the futures market, you don't need to pay for the full value of the metal you control. You post margin, a fraction of the total, and you get exposure to a much larger position. That's leverage, powerful when price moves your way, lethal when it moves against you. And then comes the lever that the exchange can pull, the one that changes everything without changing a single fundamental: margin requirements. When the exchange raises margin, it is effectively tightening the collar on leveraged traders. Suddenly, the same position requires more cash immediately. Not tomorrow, not next week. Now. If a trader is fully levered, they have only 2 choices: wire in more capital on short notice or sell positions to reduce exposure. Most cannot wire in enough capital fast enough, which means selling becomes forced, not optional. And forced selling is different from normal selling because it doesn't care about price, it doesn't negotiate, it hits bids to survive. When enough traders get hit with the same margin shock, you get a liquidation cascade. Price drops trigger more margin calls, which trigger more selling, which triggers more margin calls, and the market starts feeding on itself. This is why gold and silver behave differently. Gold got dragged in the general sell-off, but silver was the one that hit the long-term ceiling at the same moment the margin vice tightened. The transcript gives the number plainly. a margin increase on the order of nearly 50%, a jump that forces repositioning across thousands of contracts. Combine that with a historic technical rejection, and you don't just get a pullback, you get a trapdoor. It feels like the market snapped, but what really happened is that the leverage underneath the move was suddenly demanded in cash, and the crowd didn't have it. That is how paper wealth disappears, not with a single villain. With a rule change and a crowded trade meeting, a level that refuses to move. Now, zoom out again, because this isn't the first time the playbook has appeared. In 1980, after a historic run, rule changes and margin restrictions helped crush silver from the mania highs. In 2011, a parabolic silver move met a series of margin hikes and reversed violently. Different decades, same mechanism. When a market runs too far too fast on leverage, the exchange can turn the temperature down by raising the cost of carrying that leverage. Whether you call that risk management or containment depends on your worldview, but the mechanical effect is the same. It forces liquidation into a falling market, and it amplifies the move. Here's where most people get the story wrong, and where you can separate panic from analysis. A crash can mean two opposite things depending on context. In a true terminal top, a crash is the beginning of the end, the unwind that signals the bull has exhausted itself and the air is coming out for years. But inside a secular bull, crashes can be resets, violent, ugly, necessary moments that purge leverage, transfer positions from weak hands to strong hands, and set the stage for continuation. The same event can be an ending or a reload. The question is, which one did we just witness? The bearish case is real, and you have to respect it. Silver moved with a kind of speed that invites punishment, and parabolic runs often reverse with a cruelty that feels personal. When everyone crowds onto one side of a trade, the market doesn't reward that unity, it weaponizes it. Ratios compress, positioning stretches, and the moment the tide turns, the exit becomes too narrow. Margin hikes have historically coincided with major inflection points, and that fact alone is enough to make serious traders cautious. If this were purely a speculation-driven melt-up, a crash could mark the start of a deeper unwind. But the bullish case has teeth and rooted in something margin rules cannot change. The physical and industrial reality underneath the paper price. Export restrictions, structural supply deficits, shrinking deliverable inventories, and the relentless demand profile from solar, electrification, data infrastructure, and connectivity don't vanish because a chart rejected a line. This is where the investigative angle matters. During paper crashes, you look for confirmation in the physical market. And one of the strangest signals in moments like this is when the paper price falls hard, but physical premiums don't collapse with it. Sometimes they hold, sometimes they rise. That divergence is the market quietly telling you, the screen is moving, but the real thing is still scarce. And it's the kind of detail that mainstream commentary rarely tracks because it requires looking beyond the ticker. So here is the deep question I want you to answer in the comments because it is bigger than silver and bigger than this one crash. When a market is built on leverage and claims what happens when enough people stop trusting the claims and start demanding the underlying reality. In other words, if paper can fall 12% in 90 minutes while physical tightness doesn't release, which side do you believe sets the true price? The futures screen or the real-world bid for metal? And if that trust ever snaps at scale, do we get orderly repricing? Or do we get the kind of settlement games that rewrite the rules in real time? Tell me what you think, because that single question is the fault line under every modern commodity market. Now let's get practical, because narratives are useless if they don't give you a framework. If you're trying to determine whether this was a buying opportunity or the start of something worse, you watch the market like a detective, not like a tourist. You watch whether silver can stabilize around psychologically crucial levels because the ability to hold after a shock is a sign of strength. You watch whether physical premiums and delivery tightness remain elevated because that's where real demand reveals itself when paper traders are forced to sell. You watch inventory trends because a genuine easing of pressure tends to show up there before it shows up in anyone's confidence. And you watch the exchange because additional margin changes can extend the liquidation cycle and create another wave of forced selling, even if the long-term story remains intact. What we witnessed today is a reminder of the most uncomfortable truth in all of markets. Being right about direction is not enough if you are wrong about structure. Leverage makes you fragile. Margin policy makes you vulnerable. And volatility is the toll you pay to participate in an asset that can move like a rocket and fall like a guillotine. That's why, whether you're bullish or bearish, the discipline is the same. Position sizing, risk management, patience, and the willingness to think in time frames longer than a headline. Because the crash didn't erase the past year or its reality. Silver got to triple digits in the first place. A move that powerful doesn't happen in a dead market. It happens in a market that is fighting over the next regime. And this is where history gives you perspective, not certainty. There have been crashes that ended cycles, and there have been crashes that marked the middle of a much larger story. In 2008, silver touched a defining line and then went on a multi-100% run. On the way up, there were brutal shakeouts that felt like the end in real time and looked like opportunities in hindsight. That doesn't guarantee the same outcome now, but it does tell you what bull markets often do. They hurt the largest number of people at the most emotionally convincing moment, then continue once the crowd is exhausted. If this crash was a structural reset inside a secular bull, the message is simple. Today was not the conclusion, it was a transfer. $1.7 trillion didn't vanish into space. It moved from one set of hands to another, from forced sellers to prepared buyers, from leveraged emotion to patient capital. So I will leave you with this. Don't confuse a violent move with a final verdict. Understand what caused it. A multi-decade resistance rejection collided with a margin shock that forced liquidation. And together, they created a 90-minute event that looked like chaos but behaved like mechanics. If silver eventually breaks and holds above that long-term ceiling, the next phase won't feel like a normal rally. It will feel like price discovery. If it fails and the exchange tightens again, the pain may not be finished. Either way, the real edge is not predicting the next candle. The edge is understanding the machine well enough to keep your capital intact while the machine tries to take it from you. If you made it to the end, drop your take below. Are you seeing this as a warning or as the kind of reset that sets up the next leg? And if someone you know panicked this morning, share this with them, because the most expensive mistake in markets is making a permanent decision based on a temporary shock.